This is 2 hours of unreal value and insight into crypto trading from a professional trader. If you're getting into crypto and you need to know how to trade from start to finish, how pros read the markets, how to place orders, how to know when and why to trade, how to get in and out of your crypto trades for profit, and just a practical step-by-step guide of how to increase your chances of making money with crypto trading, this is it. Hey guys, James here. This is a unit by unit course to get you from beginner to confident trader. All of the resources, links, extra information, extra videos, and the timestamps for each unit are listed in the description for you. Definitely look in there to learn more, and I really hope you get a lot of value out of this video. So I'm going to get started with just telling you what the course is going to give you. At the end of this video, this is what you're going to know. We're going to start with cryptocurrency basics for beginners. Now, if you already know this and you want to skip through the beginning parts, then that is up to you. Go and check the description for all the timestamps. But we're going to go through actually what cryptocurrencies are, why you would want to trade them, then what is a stablecoin. That's really important. We're going to go through the best crypto news and education sites so that you can actually go and do your own research. Also, what are the best crypto trading venues for each and every user, because we are all different. Then I'm going to go through and compare centralized versus decentralized exchanges, why use one over the other, what are the pros and cons. We're going to go through some crypto trading strategies. So if you want to know actually how to go ahead and implement some strategies to try and get some money when trading crypto, then we're going to go over that. That will be for beginners, but that will link with a unit later on in the course, which is going to go over specifically how to actually put orders in, where to put orders in, and why we would do that. If you are new, then I'm going to go over all the crypto order types as well. So what is the order book? What are market and limit orders? Why do we use these when we're trading? Then we're going to go over technical analysis for crypto. That is a really big unit. It is chock full of information, really great information. So I definitely recommend looking at that one. After technical analysis, we're going to go through and trade. So you're going to see me go through some sample trades, why I chose that trade, where I put my stop loss, where I put my take profit, and then just a recap of the course in general. Before we get into the course and all of the units though, just a quick self-introduction. If you don't know who I am and you haven't watched the channel, used to work on the London Stock Exchange for over 5 years, got a few certificates. And this is not financial advice. I'm not your financial advisor. This video is not financial advice. Please just take it for education and information. All trading involves risk and a significant risk of loss. So just keep that in mind. Okay, let's get into it. The first unit is crypto basics. What are cryptocurrencies? What are blockchains? What are the different types of blockchain? What are the different types of crypto? And how can we use tokenomics to actually go and research cryptocurrencies? What are cryptos? They're just tokenized assets that represent value, not really much more than that. Not all cryptos are created equal though. There are better coins, better blockchains, more useful blockchains, and there are poor blockchains and low quality blockchains as well. In terms of barriers to entry, especially for us retail investors, there are very low barriers. You can sign up with an exchange, get trading straight away with very low fees. So that's definitely a positive for trading crypto over something like Forex or even stocks, 24/7 trading as well. There are different types of blockchain and cryptos that we can trade. You have blockchains that really focus on being a currency, which is just a ledger of transactions. That's all it is. So the main example there is Bitcoin. Litecoin is a fork of Bitcoin, and actually Dogecoin, I think, is a fork of Litecoin. So it's a fork of a fork. But essentially these blockchains do one thing only, and that is keep a ledger of people transacting. Now, stablecoins are a little bit different. They are definitely used as a currency, but they're not usually their own blockchain. They're usually built on a different type of blockchain known as a smart contracts blockchain. So the main one there is Ethereum. This blockchain is different to Bitcoin, whereas Bitcoin is simply a ledger of transactions. Ethereum allows people to actually enter into contracts on the blockchain, which means you can have a lot more uses on that blockchain. You can actually issue different types of tokens on Ethereum. So you might want to go and trade, let's say Uniswap, which is a token. That's actually an Ethereum-based token. These are known as ERC20 tokens. So it's good to know the differences, because when you're investing in cryptocurrencies, you've really got to know what you're investing in. Are you investing in a main blockchain? Are you investing in a different type of token? So these are the main smart contracts blockchains right now. They are very different to the currency type blockchains. Now, these are the types of cryptocurrency. What do you want to trade? What do you want to invest in? Where do you want to focus your resources. Do you want to trade currency tokens? Really here, this is like trading gold or something like that, where there's not much value apart from the value that people actually think it's worth. But then you have different types of tokens like exchange tokens. So a lot of exchanges like Binance and KuCoin will have their own tokens, so you can trade those. Different type of value proposition. You also have protocol tokens. Injective protocol is a good one. So that code actually does something specific and they have their own token. It's going to be a very different investment proposition than something like a currency token. DeFi tokens are really popular. Utility tokens could have many different uses on a blockchain and can be very important over time. You even have stock tokens, which is a way of trading the value of a stock, but with a cryptocurrency. Definitely some positives of doing that overall. And then you have NFTs, which are totally different. So all of the cryptocurrencies that you'll trade will be known as fungible tokens, the same as fiat currency. If I gave you $1 and someone else gave you $1, those dollars are the same. You can swap them around and give them back to someone else, and they are all the same, or otherwise known as fungible. Non-fungible tokens are completely different. They are like art. There's only one Picasso painting of each certain type. There is only one unique piece of art that a person makes, and so that is non-fungible. It cannot be swapped around, and that is what NFTs do as well. NFTs are a completely different value proposition and investment as well. It's like investing in art. NFTs can be used for a lot of different things though. And then we come to shitcoins and scams. Obviously, there are a lot of these and you want to steer clear of those. All right, so what is tokenomics? Tokenomics obviously is a mix of tokens and economics. We can look at the value of a cryptocurrency, the supply of it, which is super important. If it has an unlimited supply, is that going to affect the investment over the long term? If it has a very limited supply, then if a lot of people want to buy it, the price might rocket up. The volume in terms of the trade, daily, weekly, monthly, how much is the project worth? So each cryptocurrency is a piece of a wider investment. So Bitcoin has a certain amount of coins and you add all those up and then that gives you the market cap. Also, who holds that crypto? That's also super important because cryptos are really here for investors to invest, but also for projects and companies to raise money. Who's invested in it? That's obviously important to know. Burning tokens is also super important. If a company burns tokens, it literally takes them out of circulation. And if you have the same demand and fewer coins, then the price should appreciate. And then we come to one of the main reasons of a cryptocurrency, especially these days, is ICOs and IDOs, or basically initial coin offerings, initial DEX offerings, essentially just a way for the project to issue cryptocurrencies to earn money and investments so they can build their project. Let's go over to CoinGecko.com, which is a very popular site for the cryptocurrency space. And we can do some really easy tokenomics right now. Let's look at Bitcoin. Here's the price, $55,290 right now. So cryptocurrencies are valued in dollars because everyone knows what dollars are and they can easily compare it to other investments. It's the world's reserve currency. Everything is valued in dollars, so it makes sense. So this is the price of one cryptocurrency right here. And then we have the 1 hour, 24 hour and 7-day change in terms of the percentage price changes. 24-hour volume. This is all of the trading volume in Bitcoin over the last day, made up of all the different exchanges that do trade Bitcoin. It's given as a US dollar value, so $72 billion worth of Bitcoin was traded over the last 24 hours. Then we have the market capitalization, which is a very easy calculation to do. You take the price of each coin and you times it by the amount of coins in existence, and that gives you the total value of those coins. In the case of Bitcoin, this is $1 trillion more or less. Let's click into Bitcoin and we can do some more tokenomics. We can come and have a look at the market cap rank, super important. We can also go and look at the website if you want to know more about the project. Every site will have docs and you can go and read those. Also on the right hand side, you have the tokenomics again, and really important when looking at cryptocurrencies is the circulating supply and the max supply. So right now we can see that Bitcoin is nearing the limit of its supply. Once there are 21 million coins that have been made, that's it. There will be no more. And so we're getting very close to that. It's going to be a good few years from making this video until we reach that supply cap. But one of the main reasons that Bitcoin is where it is because of a limited supply and a high demand, meaning a high price. That is really very basic tokenomics though, so you can really quickly compare projects very quickly. But if you want to go deep, then you have to go to the project's website and have a look at their docs. So you can see all this information can be found in the project docs. that will be on the project's website. As an example, Solana right here, we can see the token supply distribution. This means we can see who is holding it. Seed sale, 16%. Founding sale, 13%. So founding sale is very early investors. If this is very high, are those founding investors going to sell out when the price goes up? Maybe they'll lock in some profits. So when are they actually going to sell? A lot of the time, founders will actually have a time limit. So maybe they'll have to hold on for 2 years. But once that expires, are they going to dump all their coins in the market? That could obviously put pressure on the price. So it's very good to know these things. You also have how much the team has. So the team itself that developed it has 13%, and then the community has 40%. So you can compare these distributions from one project to the next. Let's recap Unit 1 though. Cryptos are tokenized assets. That's all they are. They represent value and they are a digital representation of that. There are many types of blockchain and tokens for different use. NFTs are unique and not fungible. Cryptos are fungible. Each and every token, each and every project is very different. The tokenomics are different, so we have to know them before we start getting invested. Before we get into Unit 2, here are the best crypto news sites and info sites and how to do your own research. I've listed them here. You can go and look at them. I think these are really great and full of information and will definitely give you a lot of very good knowledge about cryptocurrencies. Let's get into the basics of trading cryptos then. And if you're getting value this far, make sure you are subscribed and also like this video. But I'm going to go through what a currency pair is. So when we're trading cryptos, we have to trade in a currency pair. Also, what is a stablecoin? Super important for beginners to really understand what these are. A base versus a quote currency, really important when you're trading. And then trading currency pairs in general. Okay, so what is a currency pair? When you trade cryptocurrencies, when you trade currencies in general, when you trade Forex, you have to trade in a pair. If you want to buy something, you of course have to sell something in return. Now, when you go into a shop, you've got all the prices there already, and the thing you're giving the shopkeeper is a fiat currency, usually, let's say US dollars. When you're buying a currency though, you have to give them a different currency. It's exactly like swapping your money at a money exchange when you're on holiday. So we are exchanging two currencies, and this is how you will see them right here. So we've got BTC slash USDT. What does that mean? Well, each crypto has a ticker. So BTC is Bitcoin, and then slash USDT. USDT is called US dollar tether. It's a very popular cryptocurrency and a very useful crypto. I'll get into what a stablecoin is and US dollar tether in a second. This is how we read a currency pair. You have BTC against US dollar tether. ETH is Ethereum, so Ethereum against US dollar tether. So you know this trading pair is Ethereum and US dollar tether. And then you have other currency pairs like Bitcoin, Ethereum. So if you just want to trade them directly, you can trade Bitcoin and Ethereum. This is how it will look. We need to get into stable coins though, because these are the entry into the crypto space and they're also used to trade against every other crypto. So a stable coin is a crypto version of a fiat currency. It is always a crypto version of a real asset. So it doesn't have to be a fiat currency. There are other stable coins that are backed by other very stable real assets, maybe like gold, but it is definitely backed by a real world asset, and that's why it's called stable coin. Its price is pegged to that real world asset. So let's take US dollar tether, which is right here. Also US dollar coin, which is this one, and then Binance US dollar. All three of these are pegged to the US dollar, meaning their value is the exact same value of the US dollar. They do this through various different mechanisms, but you know that if you are holding Binance US dollar, USDT or USDC right here, that will be worth $1 US from now going forward. So it's a really important asset for a lot of people. If you want to come out of a cryptocurrency, you think it's too risky, you can come actually into a very solid real world asset without having to take your money out, and you just put that in the stablecoin. So now we know that we trade currency pairs. We can look at the base versus the quote currency. So this is really important to know when you are trading. Here is how it will look. The base currency is the main currency that you're buying. So if you want to go ahead and trade Bitcoin, you can see down here that Bitcoin will be on the left hand side. That's the base currency. The quote currency is the currency that you're selling or using to buy the base currency. So the base currency you are using, in this case we can see BTC, it's definitely Bitcoin. And the quote currency tells us how much we need to buy 1 unit of the base currency. And I'll show you the quote right here. So we've got Bitcoin, that's BTC. So we know that that is the currency that we're trading. We can look at the quote currency, which is US dollar tether. So that is the quote. We then have 50,000. What does that mean? It tells us that it takes 50,000 USDT, which is the quote currency, to buy 1 BTC, which is the base currency. This will obviously change depending on the exchange rate between the two currencies. Once more, we have BTC against US dollar tether, now at 55,000. So it now takes more US dollar tether to buy 1 Bitcoin. This can also be shown to you in a percentage move on a day. You'll see this a lot of times. Let's go back to CoinGecko right here, and we can come up, go back to the homepage. You can see this right here. You'll get a percentage change on the day, and this is a percentage change against US dollar tether. So we'll go back to our quotes, and we can see that Bitcoin has appreciated against the US dollar by 5% today. This percentage move will always be how the base currency is valued. So it takes more US dollar tether now to buy Bitcoin because Bitcoin has appreciated 5% against the quote currency. Also really important to know when you're trading is that not every currency pair is supported. So let's say you have a really small altcoin that's like a micro cap. It's not going to be traded against Bitcoin directly. So I've got an example here of Mana, which is Decentralised. It is an altcoin against Cardano, which is another altcoin. It doesn't have a market, at least on Binance. So if you want to sell one for the other, you just can't do it. You're going to have to first trade Mana into US dollar tether, and then trade ADA against US dollar tether. So you have to use a third currency to actually trade that. This is sometimes known as a cross trade, where you use a third large currency to trade two smaller currencies that don't have a direct exchange. This is why stablecoins and US dollar tether in particular are so important. They really do help liquidity in cryptocurrencies. All of the big cryptocurrencies though do have direct trading pairs, and this is how you can trade one currency against another. So I have an example here. Let's say you took $1,000 and you invested $500 each, 500 in Bitcoin and 500 in Ethereum. They're the top two cryptos and they both go up in value. Both have gone up, so we're super happy. But you can see here, Bitcoin actually went up 20%. So our $500 times 1.2 is $600. Ethereum though only went up 10%. So $500, this thought is supposed to be $1. $500 times 1.1 is $550. Now, if you would have just put all of that money in Bitcoin, you would have made $1,200 because you would have gone up 20%. $1,000 in Bitcoin and Ethereum, you only made $150. So actually, you would have been better to just put all of your money in Bitcoin and none of it in Ethereum. Bitcoin went up more than Ethereum. And so you can see investing becomes pretty complex. And we're not going to go into diversification here and the benefits that that gives you. They might go up and down at different times, and they might have different investors. And so diversification is very key, in my opinion. But just to show you how actually trading in one or a different cryptocurrency can definitely change your investment outlook. This is what we call currency pair trading. Which one of these cryptos do you think will outperform the other crypto? You can actually bet on one crypto versus another. This is not just an investment in one coin, but you can think, well, which one of Bitcoin or Ethereum over the next 6 months is going to outperform? Then you want to put all your money in that coin. If you've done research and you think Ethereum is going to outperform Bitcoin over the next 6 months, then what's the point of being in Bitcoin? Put all of your money in Ethereum and it will outperform. You will get a higher rate of return. When you buy cryptos with fiat currencies, so if you've got US dollar or pound sterling and you're just putting money in, then you are actually betting against those currencies, pound sterling and US dollar. If you're selling those to buy cryptos, you're betting against fiat currencies and you're placing your bets into cryptocurrencies. That's what you're doing. Whenever you sell a crypto to buy one other, then you're actually betting against the one you're selling. This is the most basic strategy when it comes to currency investing, and with cryptos, the currency you're selling, you're betting against, and the currency you're buying, you are thinking that that one will at least outperform the one that you're selling. So let's just recap on Unit 2 then. Currencies only trade in pairs. You need to sell one to buy another. Stablecoins are absolutely vital for the cryptocurrency industry and for trading. We can analyze the quote and base currency to tell us more about how that currency pair in particular is trading, and you can bet on one currency versus another. Unit 3 is the best crypto trading platforms. Really important that you know the difference between them, the pros and cons of each. If you are getting value out the video, make sure you are subscribed if you aren't already. Also, everything in this video is listed in the description for you. So everything you need will be in there. Definitely check it out. What are the best trading platforms? What are the best trading apps? What do they offer us? And what are the fees of each? Let's start with eToro. I've used eToro before. Now, eToro offers many different things, not just crypto trading. You can trade stocks, you can trade CFDs, you can trade commodities, and they have something that eToro called copy trading, which is where you can essentially invest in someone else and you can copy their trades. That might be something that you want. It is definitely the best all-in-one solution, in my opinion. You don't have any trading fees here, but they take some money out of the spread. I'll explain what the spread is later on in the video, but you should be paying maybe 0.25 or 0.3%, something like that. Depending on how big the spread is, you can even be paying as low as 0.1. So I think overall their fees are competitive. You won't be paying any fees on top. They'll take those out when you trade. And you can do staking on eToro. eToro also has eToro X and eToro Wallet. They are specific crypto trading platforms and they are very good in my opinion. You do need KYC though, so you're going to have to give them your ID documents to go and trade with eToro. Overall though, a very good system. We also have Kraken, which is a dedicated crypto exchange. You have Kraken and Kraken Pro. In my opinion, Kraken Pro is really great for pros. A lot of information there, pretty much everything I would want when trading. You get some good staking products, not support for every crypto when staking, but the ones they do support have very good rates of return. They have very decent coin support overall. If you're in America, you might want to check this one out. The fees are very low, 0.26% or below, depending how much you trade. You do need to give them your ID documents. Coming on to crypto.com, this one is a loan application, which I think is very good. They want you to use crypto to buy and sell things. So they actually give credit cards as well. If you have a lot of cryptocurrency, you'll get super good rates on credit cards, cash back on purchases. So it actually lets you try and spend your cryptos in the real world, which is definitely something the other exchanges don't do. It is very CRO focused. CRO is crypto.com's cryptocurrency. You need to hold a lot of that on account and you get huge discounts off your fees and you get a lot of bonuses as well. Definitely good for some people, this one. We also have Coinbase, which is a dedicated crypto exchange. They'll be making their product offering bigger as time goes on though. You have Coinbase, which is the easy option on your phone. And then you have Coinbase Pro as well, which is slightly more advanced. However, saying that, this is for beginners only. You have very poor support when it comes to staking. You also have very poor coin support overall. And the fees are astronomical. You'll be paying 2 to 3% on Coinbase, and on Coinbase Pro, 0.5%, which isn't that great. Coinbase for me is for first timers. If you want to buy Bitcoin and Ethereum with a fiat currency, then just use Coinbase. But if you want to do anything more than that, I would suggest other platforms. We also have KuCoin, which is one that I really like as a platform. It's a dedicated crypto exchange. It is an alt exchange. So if you can't find an altcoin on another exchange, you might want to look at KuCoin. The thing with KuCoin, it's not that beginner friendly. It's not great at actually using fiat currencies like US dollar to go ahead and buy a cryptocurrency, and you can't withdraw fiat currencies from the system into your bank. It's just not something they support. This is a crypto exchange, and so it has extremely low fees, but you do need to be an intermediate to advanced user and have other exchanges as well that you can actually transfer the cryptos back to if you want to take some money off the table. There's no KYC on KuCoin. You can set up an account and start trading with cryptos. You don't need KYC. Huge benefit of this exchange. And if you are a US citizen and you're banned from other exchanges, you might want to have a look at KuCoin. Binance, though, is really the king of crypto exchanges. I would recommend every crypto trader to have Binance. They're just simply the biggest and baddest crypto exchange. They have a vast amount of products. You have trading, you have a decentralized exchange, you have derivatives on here as well. Pretty much everything that you could ever want, Binance has. It has amazing staking support as well for coins. It has amazing coin support. It has the lowest fees I've seen at 0.075. It has the highest liquidity as well. That's for Binance. Binance US is a little bit different. The product offering is different and you don't have as many coins. If you're in the US, you're just going to have to deal with that. But Binance is the number one pick for me. I would suggest that you go with Binance, at least having that as an account with some others as well. Here are my thoughts on exchanges, so you can go and have a look at them. All of these exchanges are listed in the description. You can go and have a look and see which one is best for you. I think all of these are great for different people. So let's recap Unit 3. Just pick the best platform for you. If you want to actually trade cryptos, don't use Coinbase. It's just not that great for that. Later on in the video, I'm going to get really specific with technical analysis and how to input trades. Coinbase isn't going to help you with that. I would suggest Binance, KuCoin, or Kraken if you want the pro tools. Unit 4 is centralized versus decentralized exchanges, and you may have heard of both of these. What are the pros and cons of both? Should you use a decentralized exchange? What are the benefits of DEXs? What are liquidity pools? And which one should you choose? Let's get into what is a DEX. Well, a DEX is a decentralized exchange, meaning that it's essentially just a bit of code and that's it. When you have a centralized exchange, then that is actually a company that provides exchange services and liquidity. It provides you all the systems for people to go and trade with each other. A decentralized exchange is just a bit of code on a blockchain. It has no central operator and you are on your own 100%. On a decentralized exchange, you don't actually trade with someone else, but you swap tokens. It's a really different type of trading, but you do have very low fees. You can see you can pay around 0.05%. So the fees are very low, and that's because it's literally just a computer program. So I've got two examples here. You can see Uniswap up here, and you can see PancakeSwap here. Essentially doing the same thing, but they're on different blockchains. Uniswap is on Ethereum, PancakeSwap is on Binance Smart Chain. Swapping is super different to trading. I'll get onto that in a second. But essentially, when you swap, you're just using the blockchain and the decentralized exchange to go into an existing pool of assets and use your currencies to swap for the currencies inside the pool. Very different from a centralized trading exchange where the exchange actually just matches buyer and seller directly and you trade together. What are the biggest DEXs though and the biggest blockchains for DEXs? Well, you have Ethereum, which is a smart contracts blockchain. You need a smart contracts blockchain for a decentralized exchange and swapping because you need smart contracts in there. So Ethereum has Uniswap, by far the biggest. Binance Smart Chain has PancakeSwap, by far the biggest on Binance Smart Chain. Then you have Solana, Cardano, and Polkadot. They have some DEXs growing on there, a lot smaller than Ethereum-based DEXs though. What are swaps then? You can see right here, this is a swap. You can swap one token for another in a completely decentralized way. The fees are way lower, so that's definitely an advantage of a DEX. You have to use a crypto wallet though. This is not a company that is providing you a service. It's simply a computer protocol and you need a crypto wallet and coins in a wallet to actually go ahead and swap. And the way that you swap is through a liquidity pool. So people put all of their coins in and then you can swap in and out of that pool. This is PancakeSwap right here. So you can see I'm actually exchanging Binance coin into Cake tokens and I'm using a liquidity pool to do that. Liquidity pool is a massive collection of tokens. So you have other people, and these are called LPs or liquidity providers, and they provide their tokens or just literally give their tokens into the pool to provide liquidity for other people that want to swap. The reason they do that is because they earn fees. Liquidity providers or LPs earn trading fees, and this is great. So you can actually earn fees yourself. If you have some coins, you can put them in the pool and you can earn some exchange fees, which is really great. Most liquidity pools will use an automated market maker system or an AMM. Back in the day in the stock market makers were actual people who did all that thing with their hands and bought and sold and actually facilitated trade between a buyer and a seller to big organizations. Now that is done on the blockchain by a computer system. The AMM will match a buyer and seller and will get a decent price for them both with the swap. What are the pros and cons of this? Well, DEXs are really decentralized, so no one owns them. Also, they're very low cost. You have massive access to really small altcoins, which you may want to go ahead and trade. They also offer staking and rewards. So like I said, put your coins in a liquidity pool and you'll earn trading fees. That is a way to increase the income that you get from your cryptos. There are also staking rewards as well to increase liquidity, so you get paid for that. You earn commission instead of paying it. Obviously, you pay it when you trade. There are security concerns for DEXs though. A lot of security concerns, especially smaller DEXs. There have been a lot of rug pulls, millions of dollars stolen, so that's definitely a downside of a DEX. You might just want to stick to the top 1 or 2 DEXs, and they are way too slow for day trading. We cannot use a DEX for day trading. We get no charts, we get no order book, we get no technical analysis, and they require a cryptocurrency wallet to go ahead and use them. Here is the pros and cons of a DEX versus a centralized exchange. You can read these, but essentially a DEX is very low cost. You get access to small coins. You get yield farming, so you can actually earn more. You can earn commission by putting your coins in. but it is very blockchain and very crypto. A centralized exchange is just like trading on the stock market or anything else. You have an actual company who is there providing you a product. You get ultra fast trading, you get all the pro trading tools, you get great charts, you get a lot of liquidity, which is super important when you're trading a lot of money. There are some downsides, but centralized exchanges are an absolute must if you are a trader. So what's the recap? DEXs offer swaps and yield farming. That's a positive. They only run on smart contract blockchains. They have pros and cons in terms of they're slow and they're also not great for day trading. And they also have security concerns if you go for the less well-known DEXs. We're going to have to use a centralized exchange to day trade and swing trade our cryptocurrencies. Unit 5, and we're getting into the good stuff. If you haven't done already, check the description for everything I'm mentioning in this video. Do like the video and subscribe if you haven't done already. Crypto trading strategies. This is what you want to know. So what are trading strategies? What are the best trading strategies? What type of investor are you? Are you short, medium, or long term, or are you a mix of these? And what is dollar cost averaging? Super important to know. Now this links with Unit 8. Everything I'm going to talk about from now on is really a build up to the end of the video where we're going to be trading. We're going to be going through trades, but you have to know everything first to build up to what we're actually going to do. You need to know the basics, so we're going to get into it right now. First, I'm going to come on to swing trading. Super popular. A lot of people do this with stocks, Forex, and cryptocurrencies. Swing trading is short and medium term only. This isn't a long-term strategy. You open trades for maybe a couple of days, maybe a couple of weeks, but with swing trading, you're looking maybe a few days, maybe a couple of weeks, depending on the trade. You use both technical and fundamental analysis for your trading, but we certainly rely on technical analysis for when we're getting in and out of our trades. And what you want to do with swing trading is just capture a percentage of a price move. So you want to anticipate a move in the price, either up or down, and then place your trade so that you get at least a percentage of that and make your money. One of the benefits of swing trading is that it requires less time. You don't need to be researching, can use some technical analysis here to just get right in and start trading. You can definitely make some short-term profits. And with swing trading, what I would be using is the one-day chart. If that doesn't make sense, it will do it later on in the video. We're going to be using a one-day chart for swing trading. Downsides of swing trading, could miss out on the longer term trends. You know, if you just invested in Bitcoin 5 years ago, you'd be up a lot now and you wouldn't have had to have done anything with swing trading. So that's definitely a downside of swing trading. And with swing trading, you can be stopped out a lot with short-term movements. So you actually may be right about a trade, but in the short term, the price could just move up in the wrong direction, stop you out of a trade, so you make a loss, but you were right about the trade. So that's just part of trading, one of the downsides of swing trading. Thanks to Investopedia for this image, though. I'm going to use this to describe what swing trading is. Now we can see we can use a chart, we can use some analysis and some chart patterns to go ahead and swing trade. If you think this looks crazy, I'm going to explain exactly how to do it later on in the video. We can see a small cup and handle pattern right here, and we also have a consolidation period right here. These things are what swing traders use to trade. You can get into a trade around here, you can ride that is a swing, and then you can put some stop losses in place and basically get out. So a swing in the market, you've taken a percentage of that move and then got out of your trade and made your money. I'm going to be showing you swing trading and also breakout trading later on in the video. What is breakout trading? Breakout trading is slightly shorter term than swing trading, but it can be for the same amount of time. It really depends on you as a trader. You open trades for maybe even a few hours to a couple of days, and you mainly use technical analysis, but you need also to know what's going on in the markets and what types of news may move the markets as well. We can use specific chart setups for this, and I'm going to show you exactly how I trade and how you would go ahead and do a breakout trade later on in the video. We want to capture a breakout in the price. Now, what is a breakout? Well, there are specific things we look for that show us whether there is going to be a breakout or not, and that's how you trade. It requires way less time because you're really just looking at potential breakouts and you're putting your trades in. Definitely short-term profits with this one. We can use either the one-day chart or maybe the 8-hour or 4-hour chart, depending on who you are as a trader. You could miss out on longer-term profits once more. And again, short-term swings can stop you out of your trades, making a losing trade, but it may actually go in that direction. That happens quite a lot with breakout trading, so something to be aware of. Thanks again to Investopedia for this one, but this is essentially a breakout. So what happens is trade in an asset, let's call it Bitcoin, will actually go and consolidate like this. And we use these lines, and I'll talk about that later. This is actually what we call a wedge pattern, and it is possibly going to have a breakout from that pattern eventually. So this is what breakout trading is, trying to spot areas of consolidation that could then lead into a breakout. Place your trade, get that move and the volatility in the price, and maybe take advantage of it. We can see right here, this is the area of consolidation that we want to look for. Breakout traders will look for this to place their trades and essentially try and make some money when the price breaks out of that bracket. Another strategy is called scalping, ultra short term. I'm talking intraday trades. You may be looking at a 5-minute chart, trading 10, 20, 30 times a day even. There are computer systems that scalp as well. You may open trades for a few minutes to a few hours, certainly not overnight and not a few days. Only rely on technical analysis and nothing else. You trade off tiny movements in the price. Now this requires a lot of time, a lot of effort. You have to be watching the screen at all times, but you get hundreds of trading opportunities per day. Definitely. So if you want to trade a lot, look at scalping. There are a lot of opportunities to trade with scalping that long-term investing just doesn't give you. Essentially what you're doing with scalping is actually trying to trade off other people's orders. If a huge buyer comes into the market over a very short period of time, the price may move up a tiny amount, let's say 0.25%. In Forex, it's going to be much smaller, but in cryptocurrencies, it might be 0.25%, maybe 0.1%. As a scalper, you're trying to anticipate that, get in off the back of their order and try and basically buy some crypto before they finish their buy and then sell it to them as well. It definitely requires more funds. It's very difficult and time consuming to implement, but this is what a scalping setup would look like. I have a 5-day, an 8-day and a 13-day moving average on here, and you can see all of these swings. So we have one swing right here. Now remember, this is intraday. This is a 15-minute chart. So every candlestick right here is 15 minutes. If you don't know what candlesticks are, if you don't know what this chart is, don't worry. All of this is going to be explained as we go through the video. You can see though, this is an area where we could trade. We could try and ride this up and then sell up here. We can also ride this movement as well. Now these lines here are a very simple way to try and anticipate movements in the price. We also have a movement of the price here, and we also have a movement of the price here. These are ultra short-term intraday price movements that a trader can take advantage of, and you can just make your profits like this. Now, one of the downsides is that it can move against you very quickly, but that is scalping. Then we come on to a completely different strategy called dollar cost averaging. This is not a day trading strategy. It's not a short-term strategy. It's a long-term investment strategy. Now, you are purely price agnostic. This means you don't care if it's moving short-term. You just put in money at regular intervals. You really trade off fundamental analysis, essentially meaning go and research a project, go and look at the tokenomics, go and look at the fundamentals. Is it a good project? Does it have good people? Does it have a good future? Yes, it does. I want to invest in that project over the long term. This is investment, not trading, and you don't have to deal with FOMO or fear of missing out because you're in for the long term. It actually requires little time. Really what you have to do is research a cryptocurrency or other cryptocurrencies that you want to invest in. Once you've done that, all you have to do is just go and set up your dollar cost averaging setup, and it's really simple. You don't have to trade the markets. Not interested in the short term whatsoever, and it relies on the premise that markets go up over time. Low cost, low, that should be a W, low cost, low stress. One of the big benefits of dollar cost averaging is the mentality of it. You don't have to worry about missing out. You don't have to worry about buying in dips. You're just going to drip feed investments over the long term. Mathematically speaking, there is no mathematical advantage to dollar cost averaging compared to lump sum investing. However, that's not really the whole story. So I'm going to show you some differences here. And of course, if you dollar cost average and you build up large positions in cryptocurrencies, you could face significant losses. If you go heavy into a crypto over the long term and you're not keeping up with the crypto and the fundamental analysis, that price could drop a lot and then you're in a loss. Because you're not trading daily, you can't really save that loss because you're not looking at the markets as a daily trader. But here is what dollar cost averaging would look like. All you do is choose how much you want to invest, and then you split that up over a time scale. So I've just done it once a month here. So let's say you've got $2,500 to invest in Bitcoin. So you start in May. Now, rather than putting $2,500 in, you put $500 in. The price of Bitcoin in May is 49,000. So you've got $500 worth of Bitcoin, and each Bitcoin was worth $49,000. Now in June, you add another 500, July, August, September, you add 500 each month. We can see the price of Bitcoin each month changes. 49 here, a little bit more expensive, then a bit cheaper, and then a little bit more expensive. What's great about dollar cost averaging is that you can not worry about getting in at the wrong time. You can just buy some at cheaper prices, buy some at more expensive prices, but it doesn't matter because your average price is decent. This is how DCA or dollar cost averaging compares to lump sum though. Let's say I dollar cost averaged into Bitcoin over 5 months. My investment overall, $2,500 would buy me 0.05 of a Bitcoin. Now in September, that would be worth $2,513. I've definitely made some profit here because the Bitcoin price has gone up for me and I bought some cheaper. I bought some at 49, I bought some at 49.8. It's all under this, so I'm up on my trade. If you would have just gone ahead though and invested in May, lump sum $2,500 in May, then you would have actually got a much better price because the price of Bitcoin has gone up. You would have actually bought 0.051. So you would have got slightly more Bitcoin in May because you were investing more money at the lower price. And so actually the lump sum would have made you more money by September. Lump sum's beaten out DCA in this occasion, but let's say you put $2,500 in July when the price is very high. Well, you put $2,500 in at a really high price, 50,100. And so you just didn't get as many Bitcoin. You actually got 0.049 Bitcoin. And the price now in September, you're only making $4 profit on that trade. So this can basically show you the difference with dollar cost averaging versus lump sum. If you get in early and at a low price, lump sum is better. But if you haven't, dollar cost average is great. And if you don't have a lump sum to invest right now, if you're a young guy who just wants to build up and accumulate, then dollar cost averaging for an investment really is the only way to go. So let's recap trading strategies. You can trade short-term and you trade off short-term price movements. It requires skill and knowledge. Short-term trading is a full-time job. I did it as a full-time job, so I know it takes a lot of time, a lot of effort, and you have to look at the market all day long. You can be a long-term investor, which is a completely different strategy. You can use DCA, but these are not exclusive of each other. You can dollar cost average and also have some money aside for the short term to take advantage of short-term opportunities. Also, see Unit 8 for this. We're going to be getting into some really specific details of technical analysis. So this very simple and basic overview is going to stand you in good stead for the more complex stuff in Unit 8. So if you haven't done already, make sure to subscribe to the channel. Also check the description for everything I'm talking about in this video. Tons more information and resources in the video description. Let's get on to order types. What is an order book? What is the bid offer? Or if you're American, it's called the bid ask. What is the spread and why is it important? And how do we use market limit and stop orders to actually go ahead and trade? We're going to get into all of that right now. So let's look at the order book. And this is something that beginners will look at and just think, no, I'm not interested in this. I'm going to use the easy convert feature. I don't want to see this, it's too complex, but let's break it down piece by piece and actually see what's going on here. So this is the order book, or very simply, just the open market in a cryptocurrency pair. This currency pair that the order book comes from is Bitcoin against US dollar Tether. So what we can see here essentially is buyers and sellers, and they're opening their orders to us. We can see their orders, or at least we can see the orders that they want to make public. When it comes to trading, there are a lot of orders that aren't public. When I used to trade, we used to get really big orders and then actually only show some of that order to the market. You don't want to open your hand. You don't want to tell everyone that you've got like $10 billion worth of stock to sell, because obviously the market is going to go down because they know you're a seller. They're not going to pay up. So you only show a small amount of your trade. Now for small retail investors, if you're trading $1,000, $100, $20,000, it's not going to matter. However, knowing what the order book is and looking at orders is super important. So this is really how it works. These are sellers right here. You can see all these red orders right here. These are sellers. These are people and traders in the market that have gone out and told everyone else, hey, I'm a seller and this is my price and this is how much I want to sell. Conversely, on the bottom end in green, these are buyers. These are people that are out there saying, I want to buy Bitcoin and I'm willing to pay this amount for an amount of Bitcoin. That's all an order book is. It's a group of sellers at high prices and buyers at low prices. Why? Well, sellers want to sell for the highest price possible, obviously, and buyers want to buy for the lowest price possible. When sellers and buyers are very far away from each other, you can see they're physically far away from each other right here. They're just not going to trade, and so their order stays on the system and it's not traded. When a buyer and seller meet at a price, then they will trade. Here is the best bid. This means this is the highest bidder. So the person who is willing to pay the most for Bitcoin obviously is the one that buys it before everyone else. And we can see that the best buyer right here is willing to pay $58,548.68 US per Bitcoin. Now, when you're broking or trading, you don't want to keep quoting the whole price all the time because it would be ridiculous. You have people ringing you up all day saying, what's the price? You don't want to say, hey, it's 58,548. So what we do is just take the last 4 digits and we'll say that the price is 48.68. Okay, so the trader will know, okay, so it's trading at 58.5, 48.68. Now, with cryptocurrencies, it's a little bit different because the big number can change a lot. I mean, it can change 5-10% in a day. So this might go to 59, it might go to 58.6. So it's a little bit more difficult with cryptos. But for this example, I'll say the best bid is 48.68. The next bid down is 48.64. And then the next bid down is 45.85. These other bids have got no chance of trading right now unless the market moves. On the other side, this is the best offer of cryptocurrency or the lowest seller. He's trading at 48.69. So we have the best bidder, 48.68, and the best seller, 48.69. How do we know what price Bitcoin is right now? Well, it takes the last trade. The last trade you can see in the middle here, 48.69. So actually the last trade was a buyer who paid for this seller's Bitcoin right here at 48.69. That is the last trade on the ticker, 48.69. If you want to know what these are, we've got the price of Bitcoin valued in US dollar tether right here. You can see price USDT. This is the amount of Bitcoin. So what this is saying on this order book at this price at 48.69, I've got sellers of 1.43 Bitcoin. So 1.43 Bitcoin is on offer, is on sale at 48.69. And you can see the total value in US dollar tether, $83,757. So that's it. That is all that information is. It's prices and levels of buyers and sellers. Let's get on to the spread then. The spread is the difference between the best bid and the best offer. We know what the best bid is. It's 48.68. We know what the best offer is. It's 48.69. The spread is the difference between the highest bid and the lowest offer. Spreads are really important when trading. Traders want the lowest spreads possible because once you buy something on the offer, then obviously you're going to be in a loss straight away. If I buy at 48.69 and I sell straight away, I can take 48.68. So I'm actually going to lose that 0.01 straight away. It prevents people from making free money. When you're a trader though, you want a very tight spread. This spread in particular is as tight as it gets, 68 to 69. There's nothing in there. So a very, very tight spread for Bitcoin on this day. Tight spreads are good for traders. We want tight spreads. We want a tight market, liquid market, very tight spreads. It means that we can trade often and not have to worry about the price moving a long way to actually make up the spread. Let's say the spread was a 10% difference. If you bought on the offer, the price would have to move up 10% just for you to break even. So a tight spread is favored by traders overall. Let's get on to a market order then. What is a market order? If you want to buy some Bitcoin, then we can go ahead and place a market order. A market order is when you choose the amount that you trade, the amount of Bitcoin that you want to buy, but you do not choose the price that you pay. You have no say whatsoever in how much you are paying. So where are we going to buy 1 Bitcoin? If we want to buy a Bitcoin and we're having a market order, so we know we want to buy 1 Bitcoin, but we can't choose the price that we pay, then what do we have to pay? Where are we going to pay? It's here, of course. These are sellers telling us that they want to sell Bitcoin at 48.69 and they have 1.43 Bitcoin on sale. If we're buying 1 Bitcoin, we can go to them and buy their Bitcoin at 48.69. Everyone's happy. You've got your Bitcoin. The sellers have told you their price and you've taken it. There's a few downsides to market orders though. Firstly, the pros. You can trade quickly. There's a seller right there telling you, hey, I've got Bitcoin to sell. You want to buy it? Here's the price. You can buy it straight away. It's easy to use. It's the easiest order type. You can very simply put in a market order. But the downside is that you can easily pay too much for your crypto. Maybe you want to buy Bitcoin, But maybe you're going to wait a little bit for a seller to come in because you actually might want to buy it a little bit cheaper. Well, you can't do that with a market order, and you're always on the wrong side of the spread. We know what the spread is now. If you're buying with a market order, you're always going to be paying up for other people's offers, and this is obviously higher than these bidders right here. This is the best bid. He's paying a little bit less if sellers come in, but as a buyer, you're paying a little bit more for your Bitcoin. Let's see the order book live then, and let's see how we put a market order on. This is the live trading screen for Bitcoin US dollar. We can see the base currency and the quote currency right here. We can see the difference and all the prices and all the movements. We can see the chart right here, and we can see the order book. The order book right now is going crazy. This is how order books look. The market and the prices are changing all of the time. Let's put in a market order. We can come up and we are a buyer of Bitcoin. Remember, that means we have to sell US dollar tether. Let's go to a market order right here, and you'll see the price. Cannot choose it. Just says market. Whatever the price is on this order book at the time that we press buy, that is the order we are getting, but we can choose the amount of Bitcoin. Let's buy 0.05 of a Bitcoin. And you can see we can just press buy here. We cannot choose the price. We don't know what we're getting, but we know it's going to be roughly 55,362. Looks to be going around 62.12, 62.13, 62.10 right now. So you can be pretty sure as long as you're not buying too much, you'll get that trade. But what happens, look, it's now at 85. So if you just press this at the wrong time, could actually get kind of a bad trade. So that's the downside of a market order. But very simply, buy, market, amount, press buy, and you're done. Let's come to limit orders then. Choosing the amount we trade and the price that we trade at. Huge advantage here. Remember, where are we going to buy one Bitcoin? We are a buyer now, and we're going to choose the price that we pay. Where are we going to put that order? Right here. We're a buyer. We can put the order in as a bidder, as a buyer at a lower price. So instead of paying other people's prices, we now choose the price that we pay, and we can put it at a lower price than these sellers. What we're essentially saying is, I don't want to pay your price. I'm going to wait for sellers to come in so that I get a better deal for my Bitcoin. What are the pros and cons of limit orders? Well, we can choose our price. We can join the best bidder, or even we can just come somewhere down here and just say, you know what? I'm going to wait for the market to jump around. I think I can get some cheaper Bitcoin. So I'm going to pay $40.92 instead of $48.68. The thing is though, we can't guarantee that we trade. We don't know if sellers are going to come in. We don't know if we're going to get any Bitcoin. We have to wait for sellers to come in and agree to sell us Bitcoin at our price. So that is a downside. You're not guaranteed to trade. However, with limit orders, you're usually known as something called a maker, and so you may benefit from very slightly lower fees overall, which is definitely a positive. But you can see we're not buying straight away and paying this. We're putting an order in down around this level. Let's come back to the Binance trading page and put in a limit order. So we were a buyer. We're going to go to limit. Now we can put in our price and our amount. Look, we can change the price right here. You can actually click on this right here. Let's just click on this order. You can see it changes up here. So I'll click on a bid that is a little bit below the market, changes, press on another one, changes again. Really good little pro tip there. Or we can choose 55,300. 55,300 is below the current price. You see it's trading at 390 right now. So we're not going to trade immediately, but our order will be placed on this order book, and it will actually be way down here away from this order book. But you can see we can choose the price that we pay, we can choose the amount that we buy, and then we know exactly what our order is before it goes through, because the system can just times the amount by the price per Bitcoin that we're trading. Also important to note that 55,300, we always quote in one whole Bitcoin or one whole asset. So it's not 55,300 for half a Bitcoin. It's 55,300 for one Bitcoin. And then you are only trading 0.05. And so you can see it does that calculation for you. Once you press buy, you will not trade straight away. We cannot trade straight away because our price that we want to buy at is lower than sellers are willing to trade at. So what happens? It comes down here. It will go in your open orders. You'll see it, it's there, the system knows it's there. And if the price and sellers come in and are willing to sell at that price, then you will go ahead and trade. Next, we come to stock market orders. With the stock market order, you choose the amount that you trade, but you don't choose the price that you pay or get. For cryptocurrency, the price isn't guaranteed. Remember, the word here, market, is the giveaway. Market means we do not choose the price. But with a stock market order, we can actually choose the price when the order is placed in the market. So it's a slightly different way. Now, some strategies will need this order for maybe their stop losses or maybe to buy on breakouts. So you can see it's good for fast trading and it gives you a slightly different way of trading. So with a stop market order, you're telling the system that if the price gets to a certain level, enter a market order for you to either buy or sell. If the price gets to 57,500, sell my Bitcoin with a market order. You can see the price right now is 58,209. Why would you want to sell at 57,500? Well, look, if the price is going down, which it is here, you can just say, look, the price is going down. I'm losing loads of money. I need to get out of this position and stop losing more money. If the price gets down to a certain level where I'm happy to take that risk, if it actually gets down there, then put a market order in and sell my Bitcoin straight away and stop any further losses. You can see if the price gets down here to 57.5, the system will input for you a market order and just sell out your Bitcoin. Using what we know about market and limit orders, a stop limit order then is an order where you can choose the amount and the price that you trade. Traders will use stop limit orders to add onto a winning trade a specific price level. So a stop limit order can actually be placed in different areas, and it tells the system if the price gets to a certain level, then you want to go ahead and put a limit order in. So again, the same example, let's say the price gets down to 57,500, so we're making a loss. You can say sell my Bitcoin with a limit order, not a market order. Remember, a market order, we're not guaranteed a price. We're going to get the best price in the market at that time. With a limit order, we're guaranteed to trade at 57,500, and if there is no liquidity at that price, we may not get our whole order traded. Let's come on to a stop loss order then, which is just a version of a stop limit order, but it stops your losses. So this is important for day trading to mitigate risk. You'll hear people talking about stop loss orders. It's simply an order that you put in and says, if the price gets to this level, then sell my Bitcoin with a limit order. A stop loss order must be below the current price. That's why it's called a stop loss. You're stopping further losses. So if the price gets to 57,500, sell my Bitcoin with either a limit or a market order. But a stop loss is saying I'm going to stop any further losses, and you can use a limit or a market. Doesn't really matter, but it's the same price level. People just call it a stop loss when they're actually coming out of a trade for a loss. It's important to know though, because when you're mitigating your risk when trading, we'll always use something called a stop loss as a backup to know how much our position at risk is. Conversely, a take profit order is a stop limit order, but that makes you money. So we can trade a position in profit, and this is really important for day trading to automate our trading. Again, when we're putting in orders later on in the video, we're going to be using a stop loss and a take profit. They're both the same order. They're a stop market order. We just call them different things when we're talking about losses and when we're talking about gains. If the price gets to 65,000, sell my Bitcoin with a market or a limit order, and you can see it will come up right here. This is known as a take profit because we're actually getting out of the trade with a profit. To show you how to input stop limit orders or stop market orders, let's come back to Binance. It's just over here. Stop limit, we can come in. Now stop and limit. Stop is the price that you want to tell the system to trade at. So let's say we want to take some profits at a higher price. The current price of Bitcoin is 55,260. So we're going to say at 59,000, I want to enter an order and my limit price is 59,000. What you're telling the system is when the price of Bitcoin gets to 59, enter a limit order for me, and I'm only willing to sell at 59. So 58,999, not going to sell any Bitcoin. I'm actually a buyer right here, just going to switch over to sell to make it easier for you. So stop limit 59,000 and my limit order is 59,000. When the price gets to 59, put in a limit order for me at 59. Now what you can also do is put your limit in at 58. So what you're saying is when the price gets to 59, basically just dump my Bitcoin and I'm willing to take 58. So you're probably going to just deal straight away unless you're dealing trillions of dollars worth. But that is a way to put in actually a take profit order in this case. The price is above. Now, if you wanted to put in a stop loss, what you would do is say, if the price gets to 48,000, that is way below the current price, please put in a limit order for me at 48,000. You can also change this. Maybe your limit is 47,000. Maybe your limit is 50,000. Now, if the order is 50,000, then obviously you're not going to trade. If the price is at 48 and you want to sell at 50, then you're not going to be trading. But that limit order will be in there for you. So you can play around with this stop limit order. You can do it on the buy side as well. Just tell the system what is the trigger for the order. This is the trigger price. 59,000 is the trigger price. This is the order, 59. You can put in the amount, either buy or sell, put your take profit and your stop losses in. So let's recap Unit 6 then. We have many trading options. You can make or take prices. If you put in limit orders, you make liquidity, make prices, you are a maker. And if you enter market orders, then you take liquidity from the book. Makers do get slightly lower trading fees on most trading exchanges than takers. And stop orders can limit our risk, and they can also trade us out in winning positions as well. We can use all of these orders at different times as needed. This is probably the most important unit of this whole course, technical analysis. It's a really big unit. We're going to get into some really complex things, but I'm trying to explain them as simply as possible. And we're going to take all of the information that we've got so far, plus all of the technical analysis techniques, and then use them to go ahead and trade in Unit 8. In Unit 7, we're going to be looking at chart patterns, what is a trend, how to spot a trend, super important, right? Support and resistance. Again, when you're trading, you have to know these things. We're going to look at how to use candlestick charts and indicators to time our trades. All of this information is what professional traders will use every single day when they are trading in and out of an asset. There's so much information in this unit. It's all linked in the description for you. You need to check the description. All of the resources that I talk about will be in there for you, so you can go ahead and learn more. Let's get into it. What is technical analysis? TA, or technical analysis, uses trading data to analyze and predict price patterns. That's obviously important. If we can predict the pattern of a price, we can have a higher percentage win rate for our trades. It gives us data points to compare and contrast, which again tries to increase our chances of winning trades. We can use chart patterns, price data, trading volume, and mathematical equations, otherwise known as indicators, to furnish ourselves with more information. It allows us to follow a systematic strategy that can be improved and iterated upon over time. If you do not follow a consistent strategy and you're using different strategies all the time, how are you ever going to improve it? It cannot predict the future though. Technical analysis cannot predict the future, and it is often wrong. An event will happen, something will happen. A politician in America will say something that the markets don't like. Technical analysis goes out the window, which is why some people love it and some people hate it. At the very basic level though, we need to understand candlestick charts. Candlestick charts give us data-rich trading analysis. They show us time and price details. That's really important, and it's something that line charts don't give you. Let's go ahead and analyze a candlestick then. What exactly is a candlestick? Well, each candle is a period in time. So each candle is representative, and it can be anything you want. It can be 1 minute, 10 minutes, 1 day, even 1 week. But it tells us the open, close, high, and low for the time period of the candlestick. There's two areas to the candlestick. We have the colored in part, which is the body, and then we have the lines coming up and down, which are called the wick. So we have the open right here. This is the opening price. This is where the candle starts getting colored in. And then we have the closing price right here. Now, obviously green for up and red for down. So we know that this candlestick, this period in time, is a green or an upward move. This is the open. This is the close. We know that it is an upward move because of the color of the candlestick. So we know that this is the open. We then also have the high during the trading period and the low during the trading period. So really important, basically, this is the open. Then what happened is that sellers came in and drove the price down all the way to here. Then in the same time period, buyers came in and pushed the price all the way up to this level. And then sellers came in once more. And at the end of the time period, that is where the price was. And so that is the close. It was above the open, and so we give it a green color. It's exactly the opposite for a bearish candle. We know this is the open because it's a red candlestick, so it's colored in here. The open, this is the close. During the time period, buyers pushed the price up to here, sellers pushed it down to here, but actually it closed around here. We can use the colored in part, or the body, and the wick to tell us a lot about a period of time and what traders are doing. You might have heard of candlestick patterns. There are many patterns with candlesticks, and they tell us something about the trade. This is a hammer pattern because it looks a little bit like a hammer, Well, this is a bullish pattern in this scenario anyway. What happened essentially is that sellers pushed the price all the way down here. Buyers came in though, pushed the price up, and actually at the end of the session, the price and the closing price was higher than the entry price or the opening price. During the session, sellers came in, buyers pushed the price up though. Is this going to happen tomorrow or in the next period, in the next candlestick? It may do, and if it does, that means we can use this to enter into some trades. Where's the high, the close, the open, and the low? This is the open, of course. It's a green candlestick, so we know that the start of the body is the lower line. Where is the close? That is this portion. It's a green candlestick, so we know that the price rose during the time. Whereas the low on this candlestick, it's right here. And of course, the high, there's no wick at the top. So during this time period, the high is actually the close. How do we trade this tomorrow then? Well, if buyers during this time period are pushing the price up, that could continue into the next session. Maybe tomorrow, if this is a 5-minute chart, then it will be in the next 5 minutes. And you can see that you can read this candlestick chart to say, actually, if these buyers are coming in now, it may carry on into the next session. I can buy and try and get a rising price. Shooting star, this is a bearish pattern, complete opposite of a hammer. It's a bearish pattern. It shows you that buyers drove the price high during the session, but sellers won and the price fell lower and closed lower. Will this continue tomorrow? If it does, then sellers are winning and they will push the price down. Where's the open, close, high and low? This is obviously the open because it's a red candlestick, so we know the higher line is the open. This is the close right here, the end of the body. We have the high right here of the session, and we have the low is this tiny little bit here. This is a bearish sign because buyers drove the price up, sellers came in, drove it right down and even lower to a red candlestick. Bullish engulfing pattern, super important this one, and we use it all the time to go into trades. This is a bullish pattern, it's a bullish candlestick. It shows that the bullish or up move actually engulfed the previous down move, and this is something that traders will use all the time. It represents a strong reversal in the trend for the candlestick previously. Let's zoom in right on here then. So what is it? We can see that this is the previous candlestick, a downward move. We know it's red, so it's down. But what happened in the next candlestick is that the momentum changed significantly. Sellers came in and pushed the price down here. Not only did buyers come in and push the price up, it engulfed the entire previous move to the downside. That's very bullish. It means that there's a strong difference and a strong reversal of that trade to the upside. Conversely, we also have a bearish engulfing when a move to the upside and a green candlestick is completely engulfed by a red candlestick. When you're trading candlesticks, always look out for bullish and bearish engulfings because it will represent a strong reversal in a trend, and this will obviously impact the way that we trade. Let's come back to the Binance chart then, and let's have a look at some candlesticks now. We can see this is a huge bullish engulfing right here. You had a downtrend, huge bearish engulfings right here, bearish, huge bearish sell-off. But then this session, look at this session, what a great session. If you'd have got in right here, this is a huge bullish engulfing, way, way up. Now what you'd say is, well, if this session was up, then buyers are coming in and they're having to pay ever higher prices because there aren't enough sellers. Maybe that will continue. And if you'd have gone in long right here, then after a couple of days of sideways trade, you would have made a huge amount of money on this upswing. Bullish engulfing right here. Again, this is a bullish engulfing. It does engulf the previous candlestick. So you can look for these, again, a huge bullish engulfing right here, a big down move and then a massive up move as well. So you can see these both on the bullish and bearish sides, but they do represent a strong reversal in a trend. So let's look at candlestick charts then. They give us price data for a time period. Traders use these all the time to anticipate future moves, and they show us possibly bullish and bearish ways of trading. We can use them to anticipate and form possible entry points for our trades. Coming on to chart patterns then. Chart patterns are used in conjunction with candlesticks. They give a longer term analysis of market movements. They can be bullish and bearish, and they are used with day trading and swing trading, and we know what those are now. This is a classic chart pattern. It's called a double top. So this is a bearish pattern actually, because what it shows you is that buyers keep coming in, but they keep getting battered and swatted away. And what that means is that sellers are around and the price actually may fall down. buyers are unable to push the price higher. So we can see the momentum of the chart right here going up. We can see at this point though, buyers run out of steam. Buyers are trying to push the price up, but sellers are coming in and the price does not move upwards right here. So the price moves back down, but then the price moves up again. This just means that buyers are coming in again, buying some cryptocurrency. So we're pushing the price up again. Once more sellers come in. So the move is rejected. There's obviously a lot of sellers in this market, and what that could mean is that the sellers are here and the price will fall off. So this is known as a double top, which is a bearish pattern. Double bottom is the complete opposite. It's a bullish sign. Sellers are coming in, but the price meets support at this level. Sellers can't push the price any lower because there are too many buyers buying up. And so what happens is you get a small run up, sellers come in once more, and again at this same price, buyers are mopping up at this price, and so it can't be pushed lower anymore. And so what that may mean is that there are more buyers than sellers, and so you may get an upward move in the price. And this one is great, ascending triangle. It's a really great setup, one you should watch for. Let's try and analyze this one. What is going to happen here? This is different from the double bottom and double top as it takes place over a longer time period. But you can see support right here and resistance right here. You can definitely see this pattern playing out. First thing we need to do, what is the trend? Where is it going? You can definitely see that this is an uptrend. The support and the lowest price is actually increasing. The highest price though is standing around this level. So when the price does come up to here, sellers come in, push the price lower. So we can see these moves here. This is an upward move, then you get the sell-off. Upward move, then you get the sell-off, upward move. But what you can see is that the downward moves are moving up in price over time. Then we get another upward move here, and the downward move is even smaller. You can see how the price is really going into this wedge or the end of the triangle. It's telling us that the price is becoming ever more constricted. Buyers are not willing to pay above this price, but they're having to buy crypto at ever higher levels. They can't get crypto down here anymore. They're having to pay around this level. So you're getting this wedge pattern, and this is used with breakout trading. When this happens, when this consolidation happens, you may just get a breakout because the supply is obviously constricting. There are fewer and fewer sellers, and so buyers have to pay ever higher prices. And what might happen is just a whoosh out of the triangle, a massive breakout, and that's what we want to trade. Charts never trade in a straight line. It's just not going to happen, but they trend, and it's our job to try and anticipate this. Highs and lows are important. We can see these. Consolidation is important. Consolidation of price. You can see the price range is narrowing. Super important as a trader to try and anticipate this. Higher highs and higher lows is bullish. I'm going to get onto that in a second, but you have higher lows. The lows are ever going higher, and that is a bullish sign. This is going to precede a breakout for sure. Let's get onto chart patterns though before we get onto trends. Chart patterns show us if buyers or sellers are winning. We can use these to anticipate the future. Patterns are elusive though and very hard to spot. Patterns are short term. They don't tell us about longer term trends. They don't always work either. So if you're looking at patterns, that might work sometimes, but it's very one-off. Trends are something that you might want to look at more. Trends are more easily identifiable. So let's come on to trends. Chart trends can help us spot a possible trade. Definitely. We can't trade from patterns all the time. It's just not possible. But trends will guide us more often. And if we can find, not force, but if we can find the trend, then we can ride that trend for a profit. So what we look for is consolidation of price. I'll explain that in a second. Higher highs, higher lows. That's a trend. Lower highs, lower lows. That's a trend. That's bearish. It means the price is selling off. Consolidation is key. Let's come to the ascending wedge that we just saw. This is a great example of higher lows. Let's say this is the Bitcoin chart. Well, look here. This is a low. This is a low in the price before a move up. But this is also a low. It's higher than the previous low. So we call it a higher low. Higher low, higher low, higher low. This is obviously an upward trend. The lows are ever increasing. There is less and less Bitcoin around, and buyers, even at low levels, have to pay ever higher prices. So if this is a trend, then we can expect that the trend continues, and it might even break out of this trend when the supply truly dries up, meaning a huge spike in the price out of the trend. And if we can trade anywhere around here, we can ride that move in a swing and make a profit. The exact opposite is a lower high or a lower low. So this is descending wedge. Again, it's a triangle and we can see the descending wedge right here. You have a high, but then you also have a high that is lower than the previous high, lower high, lower high, and then we have even a lower high down here. These highs that we've spotted are going lower and lower, meaning this is in a downtrend. Sellers in the market are getting ever lower prices for their Bitcoin, meaning there are fewer buyers around, price goes down, this is a trend, and we can trade that trend. Thanks to forextrading200.com for this little image here. It just shows you exactly higher highs right here, higher highs and higher lows. This is obviously an uptrend. Charts do not trade in a straight line, but an uptrend is higher highs and higher lows. Reversal in a downtrend, the highs are lower and the lows are lower. Definitely a downtrend. Always trade with the trend. Don't go against the trend, especially when you're a beginner. The trend is our friend. What is consolidation then? Because nothing just goes up and down all the time. Consolidation, you can see right here, it is just an area where the chart moves sideways. And actually, consolidation is something that traders will look for because consolidation sometimes precedes a breakout. Here is a consolidation moving up and down, but it's in a very tight range. So the price isn't actually moving up or down, but every day just sort of moving around. So these are consolidation periods. Professional traders will look at these periods to enter into some trades, try and anticipate consolidation, uptrend, and then consolidation once more. Consolidation is our friend, like I said. It gives us a strong area of trade where traders have been before. It's really important that when you're trading, you can try and find areas where a lot of trade happened before, because if a lot of trade happened at a certain level, that means there are a lot of traders with skin in the game at that price, and so different orders may come in at those price levels. Consolidation is where buyers and sellers are at equilibrium, and this can't last forever, and so you get breakout traders who trade consolidation hoping for that breakout. Let's come to the Bitcoin chart and try and see a trend on the chart. So when you're looking at the chart, what are you going to try and spot? This is a one-day chart. This is Bitcoin from a while back. So we can actually see here, it looks like Bitcoin is in a downtrend at this point. So let's draw something on the chart right here. So this is a high, you can see this high, and this is a low right here. Then coming, we have another low, and we have another high. Now this high is lower than the previous high. Then we have another low down here. That low is lower than the previous low. We have a high. This is lower than the previous high. Then we have another high and another low, sort of around the same level as the previous low. But definitely these highs are coming down. This is a downtrend. Absolutely in a downtrend right now. Let's just see what happens here. We can see that this would be probably a consolidation right here. It seems like the price isn't moving as violently, and there is definitely a consolidation in the price. The price level isn't changing too much. You've got some up days, some down days, but nothing really too much. Definitely a consolidation. What happens when there's a consolidation? Well, there could definitely be a breakout from that consolidation. Now, we have to try and understand whether it's to the upside or the downside, but after a consolidation, usually a breakout occurs, and that's what happened. And this one was actually to the downside. What you could have done then is really watched for this consolidation, put in some price levels around here, gone short. Then when the breakout occurred, you would have made a positive trade. You would have sold at this level, bought back at a lower level, made money on a short trade on that occasion. This is a cherry pick chart, of course, just to show you what trends are and what breakouts and consolidation are, because it's going to feed into actually putting in orders and trades later on in the video. Let's just recap what trends are though. You have an uptrend with higher highs and higher lows, a downtrend with lower highs and lower lows, and consolidation, which is a range bound move in the price that will eventually have a breakout of that range, and it's our job to know which way that's going and to place our trades. But let's come on to support and resistance, another way of looking at trends and areas in the chart that we need to place our trades at. Support and resistance are significant price levels of trade. Support is a price where a downtrend is suspected to stop and meet support from buyers. Resistance is a price where an uptrend is suspected to stop and meet resistance from sellers. A breakthrough occurs when resistance or support is broken, and then you have to go and look at the next level of support or resistance. So let's look at resistance and support. You can see the zones here. Charts do not trade perfectly, so you have to look for areas, but we can definitely see this area is resistance. You can see buyers are coming in, the price is going up. but it always meets sellers around this level, and so that would be known as an area of resistance. Conversely, we can definitely see these support zones right here. This is a zone where sellers are coming in, but buyers are definitely coming in and preventing the price from going any lower. So buyers at this level, they're just saying, I'm happy to buy cryptocurrency at this level and it's not going to go any lower, and so sellers aren't going to push the price down any further. The thing about support and resistance though is that they're just simply significant levels of the price where it trades. Resistance can actually come support, so kind of a difficult concept to get your head around, but they're just areas where the trade might consolidate for a little while. Resistance can definitely be there, but if price breaks through resistance, resistance can actually become support. That's vice versa for a downtrend as well, so kind of difficult to get your head around, but let's go through it. So we look at support and resistance right here, and we can see that you may think this is resistance, right? Because the price went all the way up here and it met resistance and the price came down. You might think that this is also a point of resistance as well. And even this one down here, you might think these are points of resistance. The price can't go up any higher. That is resistance. Well, yes, technically it is resistance, but when you're trading, these outlier prices are actually not that useful and don't give us really much information overall. This is because on this specific chart, the Bitcoin price was hitting new all-time highs. So it's really difficult to actually find an area of resistance and then compare that to other points previously in the chart. So let's zoom in on this chart and you'll see that I actually see the resistance right here. The reason why I've drawn the line right here is because there's much more data at this level. So I'm not going to just draw a line, but I'm going to draw an area. Now, when I draw on the chart, I do use lines because it's easier to draw a line and it's simpler to look at. But when you're thinking about resistance, definitely just don't think of one price specifically. It's definitely an area of prices. You might want to put it 1% either side. It's up to you. This is an area of resistance. And the reason I've chosen this is because you can see 1, 2, 3, 4, 5 days of trade around here. Then the price was forced down. Buyers come back in. And 1, 2, 3, 4, 5, 6, 7, 8. We'll disregard these. And then we have 9 right here. That's 9 days of trade at this level. Buyers are obviously coming in. This is an uptrend. It's an obvious uptrend, but buyers are meeting resistance at this price. That's obvious because they've tried time and time again, 1, 2, 3, to push it higher. Sellers are coming in at this price. This is an area of resistance. And then you can see when you do get a breakthrough of resistance, actually it might then just break out to the upside. This is the area of support that I can see right here. Why? Well, there's different areas right here. Let's go at this one first. You can see sellers came in and pushed this price down, and this is where it met support from buyers who came in, stopped the price falling, price went up again. What you can see though is that this area is also an area of support. Now what you can't really see here is that the wick of the candle, we know what that is now, actually came down to around this level. So that's definitely support there. Then you can see some trading around this level again, about 5 or 6 days worth. That's a lot of data that we can use. And then right here, you can see that in this previous up move, the chart did consolidate around this level again, meeting some resistance. So resistance was here, turning into support here. It can be really complex to do this. It's definitely not perfect. People have different opinions about this, but that's just a guide on support and resistance and how to try and find those levels. Let's come on to spotting this trend then in this chart. Take away the support and the resistance. Can you spot the trend? Well, definitely an uptrend here, but let's just put this one on here. Is this an uptrend now? Well, we have a low, then we have a higher low, that's an uptrend. Then we have this right here, which isn't a higher low. So I would say coming in from an uptrend, looks like Bitcoin at this point is going through a slight consolidation phase. You're having higher highs right here. These three are higher highs, but then you have a higher low, and then not a higher low. So it could actually be going into a consolidation. We had a big price move here, but it's not moving up past this one. So you could say that it's probably still in an uptrend, but certainly it's going into an area of consolidation right here. Let's just recap though on support and resistance. Significant price levels that trade bounces away from or meets support and resistance at that level. They're definitely price levels to watch out for, as we can use these to trade. Before I get into indicators, which is really important, I want to come onto this slide right here, which I'm going to show you again when we actually start trading. There's really 3 steps to a trade. Identify the trend, then identify the price action, which is support and resistance, then make your entry with candlesticks. I'm going to go through this when we're trading. It's a 1, 2, 3 step process. Identify the trend. Best not to trade against the trend. The trend is your friend. you need to trade with the trend, because otherwise you're going against the market and you've just got a smaller percentage chance of winning. Then after you know what the trend is, identify the shorter term price action. Where are the main areas that we can enter into trades from? Where's the support? Where's the resistance? That tells us where we need to put our stop loss, our take profit, and other areas. Then when you've got that, make the entry with candlesticks. What is the candlestick telling us? Is the daily trade going to go in our favor? Does it look bearish? Really, really important, and I'll get onto this slide later on in the video. Let's come to indicators. So indicators are used by a lot of people. You may have heard certain things like the moving average of the price, the RSI, things like that. All these things are mathematical models and equations that attempt to give us context in the price action of an asset. What does that actually mean? Well, it just gives us more information. It tells us how it's trading now compared to how it traded in the past, so we can try and attempt to know where it will go in the future. Indicators definitely are used by traders, and they identify trends and actually, really more importantly, changes in trends, and they attempt to simplify the process of trading and trading the trend changes. They definitely cannot predict the future though. Some people love them, trade off them, some people don't, some people are somewhere in the middle. First one, moving averages. Really simple. It's just an average of the prices over a given period, and then it smooths out those prices. A simple moving average is the arithmetic mean of prices over a given time period. So we hear a lot of people say, what's the 20-day moving average? What's the 50-day moving average? What's the 100 or 200-day moving average? That simply means it takes the closing price of each day and then puts it as an average to smooth out the price. You can actually see this gray line right here. This is the 200-day moving average. Really simply, this tells us that the current price is way above the 200-day moving average, telling us that the price has, over the shorter term, broken out and is in a very positive territory or in a bullish run compared to what it was over the last average 200 days. An EMA, or an exponential moving average, is a weighted moving average of the prices, and it gives more weight to more recent prices. Some people like SMA, some people prefer EMA. They're also used differently depending on the different equation and technical analysis that you're using. Let's come to the relative strength index, otherwise known as the RSI. This plots the relative strength of a price compared to previous prices. So it's a momentum indicator. It's telling us how big is the move, how strong is the move at this price compared to what it was before. Usually with RSI, anything around about 70 is considered overbought. This means that it's expensive and you might not want to be buying in at that price. Anything below 30 is known as oversold, possibly cheap compared to previous prices, and so you might want to be getting in if you want to go long and you think you're in an uptrend. This cannot predict how the price will change in the future though, but let's come back to Binance and see how we can put some technical analysis on the charts with RSI. So if you are using Binance, again, if you want to use Binance, you haven't got an account, check the description. You can click that link, go through and sign up for an account. With Binance though, we can come up to the indicators panel. Just very simply search RSI right here. It's going to give us the relative strength index, plotted that there for us. So really simply what we can do is just say, look, now this is 70 right here. So this is the line at 70. These areas you would say are overbought or just a little bit expensive. So we can actually put these areas up right here. This area where the chart is really overbought at 80, that corresponds to this area right here. This area at 70 and above 70, that corresponds to this breakout right here. These are obviously not areas where you want to be trading if you're going long, because you're paying way up for your Bitcoin. If you are happy that the chart isn't an overall uptrend though, then you may want to be accumulating some Bitcoin right here. So down at these levels where it actually looks to be sold off a bit, that just happens to correspond with these areas where the price is selling off. If you're a long-term hodler and you think the price is going up, then you're getting some cheaper Bitcoin there. So that's very, very simply a way to use the RSI. It's not the only way to use the RSI, but just to show you on an actual chart where the RSI can be overbought or oversold and how that corresponds with the actual prices of an asset. Next up is the average true range, otherwise known as ATR, and we're going to use this indicator to set our stop loss. Super important when we're trading. We're going to use this, and we don't have to do any calculations. We can just take the ATR, use it, set our stop loss. Very simple, quick, and easy. ATR is a measure of the daily price volatility of any asset that it's tracking. Could be stocks, could be commodities. In this case, it's going to be Bitcoin. It tells us the true amount the price could move in a given day. So what this does is actually tell you how volatile a price is. So let's say you have Bitcoin. What is the most that can move in one day? We don't know that. We would have to go through and plot all of that and do complex calculations, but the ATR gives us that. So, how much is Bitcoin going to move in a day? Can it move 1% in a day? Can it move 5%? Can it move 20%? Or it might move 5%, but what is the average percent that it's going to move? This is really important, really, because we can say if Bitcoin moves 2% on average in a day, I don't want to set a stop loss at like 1% because it moves 2% a day. So what is the largest probable move for a 1 day price move based on previous data? We have to know the volatility of the thing that we're trading. If we don't know how volatile it is, i.e. if we don't know how much in percentage terms it moves each day, how on earth are we going to try and trade? How are we going to set a stop loss? How are we going to know what price to get in at? How are we going to know when we actually take profit? We have to know data, and so average true range is going to give us that data. Let's recap Unit 7 then. Technical analysis is used to spot trends and trading opportunities. Absolutely. It really gives us the nitty gritty once we've done our fundamental research, once we've done our project research. How are we going to trade? How are we going to enter? How do we know the trend? How do we know that we're timing our entry? How do we know what price to trade at? How do we know how much risk that we need to take? We use technical analysis and indicators to make this process more simple and to give us a repeatable strategy for trading. Let's get into going ahead and trading in the market and putting through these trades. But if you've got this far, I would really appreciate if you would subscribe if you haven't already. There's lots more coming. Also, I want to highlight some resources right now that you might want to use when you're trading. First is TradingView, link in description. But if you have Binance, Kraken, or KuCoin, so if you're using one of those exchanges, you will actually get TradingView for free. Let's go to Binance Review. You can see chart by TradingView. So if you are a trader on Binance or the other exchanges that use TradingView, you can get TradingView for free with your exchange account. I think that's super good value. TradingView has a lot more to it though that you might want to go ahead and use TradingView, but you can check it out, links in description. Also Tokenomics. Essentially what Tokenomics does is put every single bit of technical analysis on earth over every single cryptocurrency and then just simplifies it and gives you scores and ratings to make your process of choosing cryptocurrencies easier. I use Tokenomics. I have an account with Tokenomics, and it's how I really just simplify my trading and choose different cryptocurrencies based on different ratings. Tokenomics uses AI chart analysis. They also have example portfolios. They have buy and sell signals, price predictions, ratings and rankings, portfolio tracking, and everything else. You can get a trial for $1.99 at the moment. Again, just use that link in the description if you want to go through and see how Tokenomics can help you. So here it is, Unit 8. Let's trade, or let's go through some trading examples and see exactly how we do it. We use everything that we've learned so far and we can go through and trade. All right, so remember this slide, I think in the previous unit, this is super important. So trends, price action, entry. This is the 3-step process that you will do when you go through and trade. You have to do it the same every time. First, identify the trend. Which way is the trend? Is it an uptrend? Is it a downtrend? That's the simplest, easiest thing you have to do first. As a beginner, you might just want to trade with the trend. There are opportunities short term where you could actually trade maybe falls in the price during an uptrend. People do that. It's more risky. And as a beginner, you might just want to forego that and just trade with the trend and see where you get. After we identify that trend, what is the price action of Bitcoin or other crypto? We have to ask, where are the main areas of trade? Where are the areas where we can get in at, set our stop loss, set our take profit, and really try and know our risk to reward ratio before we start. Next, the entry. We have to use those candlestick charts to time and get our entry right. If the candlestick chart is telling us something contrary, we might not want to get in. So that is the third part of the equation. Here it is, 1, 2, 3. Identify the trend, use technical analysis, confirm our entry and our exit. I also want to remind you about some earlier units. Remember, we went over swing trading and what that is. We're going to be using that right now. Short-term or medium-term trades using technical analysis mostly, with some fundamental analysis as well. We could miss out on some longer profits, but we are going to be actively trading here. You know what dollar cost averaging is. You know what investing is. We're going to be trying to make some shorter term profits through swing trading and through breakout trading. Short-term trades, seeing where prices are consolidating, maybe we can make some short-term profits on top of our investment account. Right, so we're back in Binance and we're going to be trading. We're going to be using the technical analysis tools on TradingView on Binance. Now you can see the chart right here, base currency, quote currency, Bitcoin against US dollar tether. You can see the price 55.5, and then the change on the day. We can see a 1 day chart here. So you can see I'm clicking on the 1 day. So each candlestick is 1 day in time. You can change this to 4 hour, 1 week if you want. I'm swing trading right now, breakout trading. So I'm going to be trading the 1 day chart. That's good for me. We've got the order book right here and we can put in our orders on the right hand side. I'm just going to go through and make this chart larger so we can see what we're doing right now and we can place our orders and see what levels we need to be at. I'm going to be using this Bitcoin chart and some of the previous trade to show you how trading works. So let's go back to the slides. So this is the previous Bitcoin US dollar chart and I've got it up on Binance right here. One thing we don't have, which you can see at the bottom, is ATR. We know what ATR is, average true range. Go back to Binance, go to our indicators right here, and you can just type in ATR, average true range. I'm going to click on that, and then we have that indicator right here for us. First thing we do, just make sure that everything is right in the top left-hand corner. We've got the right market, 1 day, and any other analysis that you want. I've got the 200-day moving average here as a line in white. Let's first identify the trend. Definitely an uptrend, no doubt about that. We are in an uptrend. The price is above the 200-day. The price is moving up. So we're definitely in an uptrend. Now what I can see right here is an area of resistance. So we got the trend and now we're into price action. Where's the price action? We are definitely on resistance right here. And actually there is some support down here as well. Let's make this a little bit bigger. Where is the price action? Definitely a bullish trend. Price broke out once, sellers came in and pushed it down and found a lot of support. So we had that uptrend. You can see the resistance right here. 1, 2, this isn't, but this is, so that's 3. Not really here, but 4, definitely. So 4 days out of 7 are trying this resistance line. We also had this resistance here. What happened previously? We had 1, 2 days of resistance at this level, then a breakthrough. Sellers came in. We have another week right at this level trying to test this resistance, and you can see the support right here. So we had 1, 2, 3, 4 days testing this support and the price couldn't break through it. In fact, sellers came in, dumped the price right here, found support at this level. We can actually look right at this candlestick. Sellers came in during this time period, price actually went up on the day. Super bullish. More consolidation, testing this support. I would hazard a guess that we're probably going to continue this uptrend. Why? Look at this candlestick. Super bullish. And this is a crazy candlestick. The candlestick confirms bullishness. Remember, we talked about bullish engulfings. We have an uptrend. We have testing of support here. We have a down day and then a huge bullish engulfing that is just a super bullish sign overall that's basically testing that support level. So this could be a breakout. We're going to go in right now, but we have to do this process. So remember, we have the support and resistance. Firstly, you can enter either when you want to. So if you've seen this and you think I'm going to go in right now, you can do that. Or you can wait until the next candlestick starts. That could be the next day if you're trading the 1 day. So maybe this happened the next morning. You might want to look and say, this was a bullish engulfing pattern. I'm going to go in right now. So it could be the start of the next day or just when you wake up your time. Obviously, cryptos trade 24/7, so difficult for that entry. But a lot of people go in at the start of the next candlestick. Then we need to place our stop loss. Where is a stop loss? Like I said, remember the ATR, the average true range. How much can this price move in 1 day? Well, the ATR right now, you can see down here. I'm going to get to the calculation. But once we have that calculation, we also need to put in a take profit. So you have your entry level, your stop loss, and your take profit. And we have calculations for all of this. So let's get into it. Entry calculations. Firstly, the open of our position. You can see this right here is 33,437. This is our entry position. That was the price at the start of that candlestick. So our entry position, otherwise known as our open, 33,437. We need to put a stop loss in though. What is our stop loss? Super easy to do. Go and put the ATR on the chart. I'll show you right here. This is the ATR. You saw me put it on. Go to technical indicators, type in ATR, put it on the chart. Make sure it's a big line, and the ATR is around 3,300. We can go back to the slide. You can see the ATR on this was 3,413. So that means that your stop loss, your entry at 33,437, your stop loss is 3,413 below that price. This is the price of Bitcoin, by the way. So one Bitcoin is 33,437. Our stop loss, we use the ATR, 3,413. Why would you place your stop loss using the ATR? The ATR is the most it can move in a day, usually. You don't want to place your stop loss too tight, because if you do, you may be stopped out, because it is normal for the price to trade in a range within a day. And if your stop loss is too close, in normal trading, you might get stopped out even though you may have a winning trade. That's why we use the ATR and place it slightly below the maximum volatile move in the price. So that's why we do that. Our take profit, 40,000. Why is it 40,000? We're up near the swing high. That is the previous high, the swing high. That is where we're going to take our profits. So the risk calculations, entry price minus ATR equals stop loss, like I said. What's your entry price? 33,437. What is the ATR? 3,413. That is our stop loss. Our stop loss is 30,024. Remember, you put that stop market order in there for your stop loss. Don't worry, I'm going to do this on Binance. Then what we need to know is how much we're risking. Super important as well. So the ATR divided by our entry price gives us our risk. It basically tells us how much we're going to lose if we get stopped out. You can see this calculation here. Entry price minus ATR, 30,024, 3,413, which is ATR divided by entry price equals 0.1, otherwise known as 10%. I've put 0.1 in red here because that's how much we would lose if the trade went against us. And I put 10% in green because we're risking 10% of our portfolio. Now we're spot trading here, meaning you're just paying in cash. We're not trading futures or anything. We're not getting into that. But if we place a stop loss 3,413 away from our entry, we'll lose 10%. And I'm happy risking 10% in my position for this trade. If I lose, I'll lose 10%. But let's see it on the chart. This is our entry in blue. Our entry, 3,3437. You can see the ATR right here. ATR is 3,413. That's our stop loss. Our entry minus ATR, we're at a level of 30,024. You might want to just say 30,000 to make it easy. Next, what's our take profit? Here's our take profit. We're going to have a take profit near the latest swing high. We're in an uptrend. We want to ride the uptrend. We don't want to put a crazy take profit in though, because this is where the price met resistance before, and support and resistance, it may meet resistance again. So place your take profit slightly below the latest swing high, because up there is going to be a lot of traders, a lot of sellers selling into that resistance. So don't be greedy, sell it a little bit below. We're going to set it at 40,000 because that is a nice round price. You may even want to set it at like 39,950, just so it's not a round price that people may sell into. You can see right here, this is our potential loss. It's a 10% potential loss if you're trading cash. If we lose, we're going to lose 10% of our portfolio. If we win, you can see our profit calculations right here. Profit calculations, take profit price divided by entry price. So that's 40,000 divided by 3,3437. That calculation comes out at 1.19, otherwise known as 19, rounded up to 20%. We have a 2-to-1 ratio on this trade. That is a good ratio, really good ratio. That means you can actually be wrong 50% of the time and still make loads of money. If you win every time in a 2-to-1 ratio, you're going to be making money. This is a great risk-reward ratio trade. But you may say, well, what is that profit and loss? You're just picking numbers out of the air. Yes and no. We're using support and resistance for these levels. It's all that we can go off. The support and resistance that we found at these levels. There's support down here. We can see that. There's also resistance here, and that's what we want to break out. And then the next resistance is the big swing high that we're trying to trade off. It's all that we have. These are the numbers, the support and the resistance, the trends that we have to go off. Back in Binance, and I'll show you exactly how to put these orders in. Firstly, for the buy, our entry, we have to place a limit order. So the limit was 33,437. So we come here, 33,437. How much you want to trade is up to you. If you want to trade big boy bucks and like 10 Bitcoin a trade, probably not best. 0.05 Bitcoin, okay, that works out. We're trading 1,600 bucks. Place that limit order, place that buy, or just go ahead and do a market order, but you might get a worse trade. Next up, put your stop loss in. Remember, that's a stop loss order. Come back to the chart right here, go over to sell because you'll be a seller for this specific order. Stop limit right here. 30,000, more or less 30,000, 30,000. You're telling the system that if the price gets down to 30,000, sell out. Okay, you stopped out of your trade. Trade's over. Make sure you put the same amount as you went long for. So exactly the same. If you're trading 0.05 of a Bitcoin, trade that 0.05 of a Bitcoin. You see the total's 1,500. So yeah, we would have lost a couple of $100 if the trade moves against us. Then put in another sell order. Remember, a take profit is simply a stop limit sell order above our trade because this is a take profit. Come back to the order, check the system. How much is our take profit? Our take profit is 40,000. 40,000, then put the limit as 40,000. Same amount of Bitcoin, press that sell, $2,000 you'd get. Again, if you're trading $1,600, you would have made $400. Really good trade, and that is how you put it in the system. All of your orders that aren't executed or haven't gone through yet will be down in your open orders. You can view them, cancel them, and if they have gone through, they'll be in your order history. Let's go back to these risk calculations. Absolutely everything in here has been input on to Binance. Let's go back to Binance, see how this trade went. Remember, we're in around this level, stop loss down here. Want to take profit around 40,000. Here's the next day's trading. Wouldn't have got up there. So 38,500. That was intraday. Didn't finish there, but didn't quite meet our take profit. Again, we're getting a big breakout here, and there you go, bang. We got that 40,000 here. We would have been traded out 40,000 near that previous swing high, and we would have lost out on money. Now, this is one of the downsides, I would say, of putting in definitive stop loss and take profits is, you're going to lose out on longer term profits possibly. But the more lax and loose you are with these orders and the amount that you're trading, it's more risk. So it's up to you, but we would have missed out on this and also this, but we would have made very decent money. And then you can go again with a different trade later on. You can let your profits run. You don't have to put a take profit in there. You can actually just raise your stop loss level to make it so that you will make money out of the trade, and you won't lose because your stop loss level can now raise up. So if you don't want to put a take profit in there, you don't have to. You can run your winners if you want, but this is just to show you, and you can make that choice as you want. Next example. What is the trend? We're in an uptrend. That is obvious. The 200-day moving average, we're way above it. We're obviously in an uptrend, so we know the trend right now. What is the price action? This is a bullish trend. We know that. Price broke out once. You can see that here. Sellers came in. Price found lots of support, moved up. Sellers came in again right here. This is ripe for a breakout because we can see what is known as a small move. See, this day is a huge move. This day is a huge move. So we just traded this one. We just traded this move right here. We went in here and then we sold out around here. Then we have another huge move up to the upside. Again, you might have wanted to trade this, but I'm doing this after this pullback. We have a huge bullish engulfing right here, absolutely huge. And you might have wanted to go in at that point as well. Let's say you didn't for whatever reason, because it had a sell-off right here. Then you had the big sort of recovery day, kind of volatile. You might want to stay out of that market. But then we have consolidation. Like I said, consolidation is key. Let's see where the support is. Support's here, right? We can see that. We have 1-2 days of support right here. After a big move up, you'd expect sellers to be coming in, right? Huge move up. Sellers are coming in? Yeah, they did, but they found huge support right here. There's definitely buyers in at this price around 44,000. Price went up, came down, definitely found support here again. Sellers pushed it down. This is definitely an area of support. Where is the resistance? Definitely here. We can see the price was coming up and kind of found a little bit of resistance here, but also here, 1-2 days of resistance. Absolutely, definitely resistance right there. Let's move in on this. Can you see the candlestick chart? Like we said, classic hammer candlestick right here. It's not absolutely perfect like we saw in those diagrams. Real charts never are. You can see a huge down move, sellers trying to push it down, moving up right here. Definitely a hammer. That's a bullish move telling us that buyers are pushing it up. And for this session, it finished green. We have the support, we have the resistance, we have the trend, and we have the candlestick pattern telling us that we could be in bullish territory. Let's come here to trade. Remember, we enter at the start of the next candle. We place our stop loss 1 ATR from the price that we get in at, and we place our take profit near the last swing high. These are the entry calculations on this trade. Open at 48.80, so you can see that right here. Next up, we need to see the ATR for the stop loss, 4,000. So Our entry level 48,800. The ATR is 4,000, so that gives you 44,880 for our stop loss, and then our take profit we could say around 57,000 near the latest swing high. So remember, risk calculations, entry price minus ATR equals 44,800. So that is our stop loss. Just so happens to be really near levels of support as well, which is super great. So remember, we have support here and support here. Really great that our stop loss is at or just a little bit below that to give us some breathing room just in case it comes down and then moves back up. Our at-risk position, 4,000 divided by 4880 is 0.08, otherwise known as 8%. That is our at-risk position because we use the level of support and the ATR. You're risking 8% here. $1,000 trade, you'd be risking $80. Profit calculations. Our take profit divided by our entry price, 1.17, otherwise known as 17%. A 2-to-1 ratio yet again. This is our take profit. Here is our area of loss. Here is our area of profit. I like this ratio. It's a 2-to-1 profit ratio. Let's go back to the real Binance chart and see how this trade did. Remember, so we've got our hammer here, got our reversal here. How did this trade do? Did it come and test our stop loss right here around 44? We can see that it never even got anywhere near, and yeah, we got out, took our profit on that trade. That was another profitable trade for us on this one. This is our third example in this chart, and this one's a little bit different. So sometimes trades don't go our way, but we put our stop loss, our take profit, see where we end up. Where's the trend? Definitely in an uptrend. We are still having higher highs, higher lows. You can see right here an area of consolidation though. Moving through to the price action. We're definitely still in a bullish trend. We have higher highs and higher lows. There is a mini consolidation right here though. And so with consolidation, we could be primed for a breakout. We also have a bullish engulfing on the candlestick, as you can see. This candlestick, then we have the bullish engulfing right here. It looks to me like buyers are testing this price. 1, 2, 3, 4 days, 5 days, 6, 7 days. I want to go in here. Another price, and you have to look at fundamentals in the market in general. 60,000. It's such a psychological barrier for a price. But at this time, we're in an uptrend. Resistance at 60. Consolidation, resistance at 60. It's going to break out, right? We're in an uptrend. Resistance for a week at a price. The price is consolidating, getting narrower and narrower. We're in for a breakout, either up or down, but we're in for a breakout. We're going to go into this trade. So once more, where is the support and where is the resistance? Right here around these levels, you can definitely see support, definitely see resistance, and we're getting this testing of this price right here. Total mini consolidation. So we enter at the start of the next candle, we place our stop loss 1 ATR away, and we take our profit near the last swing high. Problem is though, there is no swing high. This is basically an all-time high. Let's go to the Binance chart and you can see it right here. We're basically at an all-time high right here. The all-time high was 61,000 and it got sold off right there. Where do we put our take profit? There's no level that we can go off. We just have to kind of wing it here. We're in breakout territory. We really can't have any other level that we place to actually find a take profit. So we're going to have to kind of take an average of what we usually make. So let's say we open at 58,142 on this next candlestick. The ATR right now is at 3,000. So 58,142 minus 1 ATR is 55,142. Where is our take profit? Absolutely no idea whatsoever. We have no other data at this price level. And so we're just going to have to put a number on there. But we can work out our risk calculations. So we're entering at 58,142, 1 ATR down at 55,142. That red line on the chart is a little bit below where it should be around about here, 55,142. Then we have our take profit. We don't know where to put this. Now, if our stop loss is 5% away from our entry, that is what 1 ATR away is. 3,000 divided by 58,142, 0.05, which is 5%. What is our profit? Well, we're in an uptrend. Let's say 15%, right? Because our other trades, we were making good money, like 17%, 16%. We're going to try and make a 3-to-1 ratio on this trade because we're taking not much risk at all, just 5% risk. So let's just try and go for a 3-to-1 ratio, 15%. This is our stop loss. This is our take profit up at 67,000. Back on the chart, we can see how this goes. So we entered around 55 around here. So we can see it moved up, really great, but it didn't get to our take profit. It only reached 63. Now we would have been in profit here. We could have taken our profits here, but we were getting a little bit risky. We were saying, no, I know the market better. I'm a good trader. I made 2 profits in a row. So I'm just going to let the position run and I'm going to go with it. But we can see, boom. I mean, we would have been stopped out. After this move up here to 63, just had a huge sell-off. Remember, our stop loss was at 55, that level. It's just gone. We would have got stopped out. So this is a losing trade. It shows you how precarious trading is and those take profit levels are. Now, what you could have done up here is raised your stop loss above your entry and just said, I'm going to let this trade run because my stop loss is above my entry, so I'm guaranteed not to lose money. You can put your stop market order in there, so you can come through like we did before, put your stop market in there and actually change the order. When the order's in, come down to your open orders, change that order, move the price up to around about your entry, so your at-risk position's basically 0 and you're running that position. Definitely could do that, but if you didn't do that and the position ran, then yeah, you would have gone up a little bit and then boom, stopped out of your trade. Learn from these 3 trading examples. Well, we identify the trend, only trade with the trend when starting out. Find the price action and chart patterns plus the indicators, then find the candlesticks for our entry point. Make sure you enter your trade and manage your risk with the formula that we saw, ATR for your stop loss, and then look at a level to get out. You don't have to use these specific indicators. There are many other indicators that other traders like using and will use over the ones I've used. But this is really to give you a simple overview of how we put together technical analysis and entry points, plus some risk management. If you want to go ahead and trade, all of the best exchanges that I use in the description, click on those links to go through and sign up and start trading. Also, if you want some of the best analysis tools and tools to help you with your trading and the information, those links are in the description. TradingView is really good. Tokenomics has literally every ratio under the sun and then just gives you a very simple way of analyzing cryptos overall. Crypto is unpredictable and it's super high risk, so definitely keep that in mind. Technical analysis is not perfect always. Holding quality projects over the long term may be better for you. These charts were cherry picked to just show you examples of the strategies that we're using in this video.